In 2026, 4 economic time bombs will detonate simultaneously. This has never happened before in recorded history. Not in 1929, not in 2008, not ever. And here's why the 2026 crash will be different from every other crash you've studied. We're not talking about a single crisis spiraling out of control. We're talking about 4 separate structural failures converging at the exact same moment in time, each one powerful enough to trigger a recession on its own, all of them hitting together in a span of 9 months. Let me show you what's already been set in motion. Time bomb. Number 1. The debt maturity wall. $4.5 trillion in corporate debt matures between January and September 2026. Time bomb number 2. The demographic cliff. 4.1 million Americans turn 65 in 2026. The largest single-year retirement cohort in history. Time bomb number 3. The commercial real estate implosion. $929 billion in commercial real estate loans mature in 2025 and 2026, while office vacancy rates hit levels not seen since 1979. Time bomb number 4. The dollar's endgame. Foreign holders of $7.6 trillion in US Treasuries begin unwinding positions as American banking instability becomes impossible to ignore. Here's what people don't understand. Previous crashes had 1, maybe 2 factors. The 1929 collapse was stock speculation and bank failures. The 2008 crisis was housing and derivatives. But 2026 has 4 simultaneous detonations. June 2026, corporate debt rollovers spike. Third quarter 2026, commercial lease expirations accelerate. September 2026, demographic selling pressure peaks. This isn't a prediction. It's a mathematical certainty already locked into the system. The dates are set, the debt is scheduled, the demographics are fixed. To understand why 2026 is inevitable, you need to see what's already been set in motion. Let's start with the first detonation point. Time bomb number 1. The debt maturity wall. $4.5 trillion in corporate debt matures between January and September 2026. Here's what that actually means. Between 2020 and 2021, when the Federal Reserve dropped interest rates to 0, corporations borrowed money like it was free. Because it practically was. Companies issued bonds at 2%, 3% interest rates, and they borrowed trillions. The problem is, bonds have maturity dates, and those dates are coming due. When that debt matures, companies have to pay it back or refinance it. But refinancing today doesn't happen at 2% anymore. It happens at 7, 8, 9%. Let me show you the math. A company that borrowed $1 billion at 3% was paying $30 million annually in interest. That same company refinancing at 8% now pays $80 million annually. That's a $50 million increase in debt service. Multiply that across the entire corporate sector and you're looking at $225 billion in additional annual interest expenses that must come from somewhere. Where does it come from? Layoffs, reduced investment, dividend cuts. And for many companies, it doesn't come at all. They default. Who's most exposed? Commercial real estate companies holding $1.5 trillion in debt. Zombie corporations, 19% of all publicly traded companies already operating at a loss, kept alive only by cheap refinancing. Private equity leveraged buyouts from the 2020 to 2021 boom, companies loaded with debt specifically because money was cheap. When these companies can't refinance, they don't gradually decline, they default. And when they default, the banks holding that debt face massive losses. And when banks face losses, they stop lending. And when they stop lending, the credit contraction accelerates. In 2008, we had $800 billion in toxic assets that nearly destroyed the system. In 2026, we're looking at $4.5 trillion maturing in 9 months. But that's just the first time bomb. Time bomb number 2. The demographic cliff. 4.1 million Americans turn 65 in 2026. That's the largest single-year retirement cohort in American history. And here's what should keep you awake at night. These aren't just any workers retiring. These are peak earners exiting the workforce and peak spenders stopping consumption simultaneously. The average 65-year-old reduces consumption by 42% the moment they retire. They stop buying new cars, they stop renovating homes, they stop taking expensive vacations. And at the exact same time, they flip from being taxpayers to Social Security recipients. That's a $38,000 annual fiscal swing per person. 4.1 million people times 38,000 equals $156 billion in fiscal deterioration in a single year. But the real crisis isn't government finances, it's the stock market, because those 4.1 million retirees need to fund their retirement somehow, and that means selling stocks. 10,000 boomers retire every single day, and each one is liquidating portfolios to generate income. The stock market needs $450 billion in new buying annually just to absorb boomer selling pressure. But here's the problem. Millennial wealth accumulation is 45% behind where boomers were at the same age. There aren't enough buyers to absorb the supply. When you have massive selling pressure and insufficient buying pressure, prices fall. It's not complicated economics, it's basic supply and demand. And this isn't a one-year problem. This is the beginning of a 15-year demographic winter. Every year from 2026 through 2040, we'll see 3 to 4 million boomers retiring annually. But 2026 is the peak, the single largest wave hitting all at once. But those two factors alone, the debt maturity wall and the demographic cliff, wouldn't create the biggest crash in history. It's what they trigger that matters. Because when corporate defaults accelerate, and when stock selling pressure intensifies, they both point to the same breaking point. Time bomb. Number 3, the commercial real estate implosion. And here's where it gets worse, because when those banks start failing, they trigger the 4th time bomb. Time bomb number 4, the dollar's endgame. Right now, the US dollar holds a special privilege that no other currency in history has ever maintained for this long. 88% of all international transactions happen in dollars. $12.8 trillion in dollar-denominated debt is held outside the United States. Countries need dollars to buy oil, to pay debts, to conduct trade. This demand keeps the dollar strong, despite America printing trillions. But there's a crack forming, and 2026 is when it splits wide open. BRICS nations, representing 45% of the global population, are accelerating de-dollarization faster than anyone in Washington wants to admit. China and Saudi Arabia are conducting oil deals in yuan. India and Russia are trading in rupees. The UAE is accepting yuan for oil purchases. These aren't symbolic gestures. These are structural shifts in the global monetary system. And here's the specific trigger. When US regional banks start failing in 2026, foreign holders of dollar assets see the same thing Americans see. Systemic instability. Foreign central banks and investors hold $7.6 trillion in US treasuries right now. Let me show you the math on what happens when confidence breaks. If even 10% of foreign holders dump treasuries, that's $760 billion flooding the market. Treasury yields don't stay at 4.5%. They spike to 7, maybe 8%. And every 1% increase in interest rates costs the US government $360 billion in additional annual interest expenses. The deficit is already $2 trillion annually. A 3% spike in rates adds $1 trillion in debt service costs. The government must borrow more money just to pay interest on the money it already borrowed. Britain faced this exact scenario in 1976 and needed an IMF bailout to survive. The US economy is 50 times larger than Britain was in 1976. There is no institution on earth large enough to bail out the United States, which leaves exactly one option: print more money. The Federal Reserve has already printed $5 trillion between 2020 and 2023. The balance sheet still sits at $7.8 trillion. Another crisis means another $3 to $4 trillion in quantitative easing. Here's the math that should terrify you. $3 trillion in new money printing, plus $760 billion in foreign treasury selling, plus $450 billion in boomer stock liquidation, equals $4.2 trillion flooding into markets in 12 months. The 2008 crisis saw $1.4 trillion in quantitative easing spread over 6 years. 2026 will see $4 trillion in 12 months. Inflation doesn't stay at 3 or 4%. It goes to 12, maybe 15%. In months, not years. 4 time bombs, 4 separate crisis factors, all detonating in 2026. And here's what the crash actually looks like. Quarter 1, 2026. January through March, $1.1 trillion in corporate debt refinancing begins. The first wave hits exactly as scheduled, not because of panic, but because of calendar dates written into bond contracts 5 years earlier. Zombie corporations, the ones operating at negative cash flow since 2021, can't refinance, they simply cease operations. Stock market volatility spikes, the VIX jumping above 35 for the first time since 2022. The media narrative forms quickly. This is contained to overextended companies, nothing systemic, nothing to worry about. Regional bank stocks drop 15 to 20%. Treasury yields climb to 5.2%. Everyone pretends it's manageable. Quarter 2, April, the first major domino falls. A Fortune 500 company with $42 billion in debt load files for bankruptcy protection. It's not a dramatic collapse, it's a quiet default that reverberates through every credit market simultaneously. May brings the commercial real estate defaults. 3 major office REITs collapse within 2 weeks of each other. June 18th, 2026. This is the exact moment everyone realizes it's systemic. A regional bank with $83 billion in assets fails. The largest bank failure since 2008. The FDIC insurance fund, sitting at $128 billion, takes its first massive hit. And then comes the announcement that changes everything. The FDIC needs emergency funding from Treasury. Stock market down 18% from January. Credit spreads explode, junk bonds yielding 12% and climbing. Quarter 3. July. 3 more regional banks fail in 1 week. The commercial loan market freezes completely. $447 billion in office leases expire, and companies abandon space rather than renew because nobody's coming back to the office. August sees foreign treasury selling accelerate to $200 billion in a single month. The Federal Reserve announces emergency liquidity facilities, $2 trillion deployed instantly. The dollar drops 8% in 3 weeks. September. A top 20 US bank fails. Too big to fail becomes too big to save. Deposit flight begins. $800 billion withdrawn from regional banks in 30 days. Quarter 4. October brings the real crash. S&P 500 down 42% from peak. Treasury yields hit 7.5%, despite the Fed buying everything in sight. Inflation reading 11.4%. November sees multiple bank failures weekly. Credit card defaults reach 8%. Auto loans at 7%. Levels never recorded in modern history. December, we enter true uncharted territory. Federal Reserve balance sheet hits $12 trillion. Dollar down 15% year over year. Unemployment spikes to 8.2%. And this is just the beginning. Here's what makes 2026 fundamentally different from every crash you've studied. In 2008, we faced a housing crisis and derivatives, roughly $2 trillion in toxic assets. The Federal Reserve had credibility. They could cut rates from 5% to 0. They could print $1.4 trillion over 6 years. And it worked because global demand for dollars was rising. China was buying treasuries, adding $1 trillion to their holdings. The dollar strengthened as a safe haven. Now, we're looking at $15 trillion in converging crises. The Fed already burned its credibility fighting inflation. Rates can't go negative. China isn't buying treasuries, they're selling them. And the dollar weakens as the crisis source, not the safe haven. In 2008, the Fed could print money without triggering inflation because the world wanted more dollars. In 2026, the Fed prints money while the world wants fewer dollars. Same action, opposite result. And here's what people still don't grasp. You can't stop what's already scheduled. 4.5 trillion in debt maturity isn't a forecast, it's contractually locked in. 4.1 million retirements aren't a projection, they're demographically certain. 929 billion in commercial real estate loans aren't estimates, they're legally maturing. These are scheduled events, not predictions. The policy trap is absolute. Raise rates and you accelerate defaults. Lower rates and you accelerate inflation. Print money and you destroy the dollar. Don't print money and the banking system collapses. There is no solution because the choices were made in 2020 and 2021 when we printed $5 trillion and kept rates at zero for 2 years. Now we pay the price. The 2026 crash isn't coming. It's already here. We're just living through the opening sequence. And here's what makes 2026 faster than anything in history. The 1929 crash took 3 years to bottom out. 2008 took 18 months. 2026 will take 9 months. Information moves instantly now. Capital moves instantly. Panic spreads instantly. 80% of trading is algorithmic, which means when sell signals trigger, everything sells simultaneously. No human hesitation, no second guessing, just execution at computer speed. By the time mainstream media admits we're in crisis, the crash will be over, and the restructuring will have already begun. Will we see bank holidays? Check the pattern from 1933, capital controls. Check the pattern from Cyprus in 2013. Inflation or deflation? Both, simultaneously, in different asset classes. Social unrest. Check the pattern from every previous depression. This isn't about fear, it's about pattern recognition. The 2026 crash will be the biggest in recorded history because 4 separate crises are converging for the first time ever. Subscribe if you want to see what comes after the crash, because that's when the real transformation begins.